Hello everybody and welcome to another Stock Probe video. Today's video is about Volta's second quarter earnings results. Just a disclaimer before we begin, this is not investment advice. This is just information about Volta's latest quarterly report. Do your own research before buying any company's stock. Before getting into the main portion of the video, I'm just going to touch on Volta's installations for the quarter. Volta installed a total of 372 new stalls in quarter 2. That's 71% growth quarter over quarter and 180% growth year over year. Volta had a total of 2,920 stalls operating on their network as of June 30th. That's 48% growth year over year. These stalls are located at 927 different sites in total. Their backlog includes 88 stalls currently under construction, 1,341 stalls in the site engineering and permitting phase, and over 4,200 stalls under technical evaluation. Volta also reached a new milestone of over 1 billion monthly impressions during the second quarter. That's something that's really important for their media revenue. Now I'd just like to highlight some of Volta's biggest strengths in my opinion. Volta has a unique business model among others in the EV charging industry. If a business were to use ChargePoint stations, for example, they'd need to pay for the station's hardware and installation and recurringly pay ChargePoint's monthly subscription. Compare that to having Volta stations, where the site host's upfront cost is potentially lower and can earn them revenue by leasing their land to Volta. Volta even partnered with the city of Hoboken during this quarter to install 25 stalls for the city free of charge. This is good for the city since they can provide EV charging to residents with no impact to their municipal budget. And it's great for Volta because the New York designated market area is of very high quality with very high advertising demand. Businesses are interested in EV charging stations for their potential to bring in more customers. For the time being, a lot of those customers also earn a higher income and typically spend more at the business. The benefits of station ownership are nice, but for most businesses those benefits aren't worth the expense and hassle of buying stations and operating them themselves. If a business could get stations in their parking lot at a lower cost and make recurring revenue by leasing their space out, then it makes a lot more sense for them. They get the additional shoppers and they don't need to pay a monthly subscription for it. Volta is also able to earn the same amount of media revenue whether the station gets used or not. A number of other charging companies that own their hardware make their revenue from electricity sales alone. This means that they need to earn high margins on the sale of electricity, and there's no revenue when the station isn't being used. Since Volta is going to be having 2 streams of revenue per station soon, they'll have a lot of pricing options available to them. Although they'll be starting to charge drivers for electricity, Volta plans to continue using their media revenue to offset those electricity costs. Being able to charge your car for a lower price is the main reason drivers will probably prefer charging at Volta stations. So, while the price to charge for drivers will no longer be free, it will still be lower than other networks whose business models require high margins on the sale of electricity. Those companies will either need to get out of the retail charging space or adopt Volta's advertising model. We're already starting to see the latter of that happen with Blink's upcoming Vision IQ 200 product. As part of Blink's Quarter 2 earnings report, they showed a new design for that product that looks exactly like a Volta stall. The product is supposed to become available soon at some point in Quarter 3. One thing that was said on Volta's earnings call is that everybody else's business model of charging for electricity is available to Volta at the flip of a switch. However, Volta's advertising model requires the right team, experience, and partners. Basically, it takes a lot more work for competitors to adopt Volta's model, but Volta can adopt the model of their competitors in a very short amount of time, which they're doing right now. It should be interesting to see how Blink does with their Vision IQ 200 product. Another thing is that Volta's business model is great for the long term because owning the stations themselves provides them with recurring revenue for the station's entire usable life. On a site-by-site basis, Volta can balance the supply and demand on both the advertising side and charging side to optimize their station revenues. During this report, Volta also announced that the revenue per stall was almost $4,000 in Quarter 2. That media revenue is seasonal, so that revenue per stall number should be higher in the back half of the year. They also commented on their selling general and administrative expenses. Those totaled $43.9 million in Quarter 2. That number has previously been very high, and it still is, but it's been reduced by $12.3 million since Quarter 1. That's down 22%. On the earnings call, Stephen Polatsky, the chief accounting officer, acknowledged that high SG&A expense and that they have further work to do to improve it. Volta reiterated previous guidance for the full year for total revenue to come in between $70 and $80 million. They guided for a total number of new stalls to be in the range of 1,700 and 2,000 installations for the full year. They also guided for their full year gross margin to fall into the 25 to 30% range. They provided guidance for third quarter revenue to land in the $17 to $18 million range. This number is lower than anticipated, not fitting in with Volta's previous revenue seasonality guidance. This was brought up during the Q&A segment of the earnings call, and Brent Hastings pretty much said that the advertisers are reprioritizing their spending for the back half of the year. He said that in recessionary times, advertisers cut down their spending and only focus on media companies that deliver the best results. Because of that, we should be looking more towards quarter 4, more so than quarter 3. I'm not sure if that's actually what's going on, but he said that he heard that information from the chief marketing officer. Using the full year and quarter 3 revenue guidance together with the quarter 1 and quarter 2 revenues, we can see that they're guiding for a quarter 4 revenue range somewhere between $29.3 and $38.3 million. They said they're still working on eventually raising capital. It sounds like that's probably going to be done by taking on new debt. This has been in discussion for a number of months now, but no further details were really provided. Taking a look at Volta's balance sheet, we can see that their cash line is really starting to dwindle down. It's been getting lower and lower every quarter. Cash fell just a hair over $100 million in quarter 2, and current assets fell by $86.4 million. Long-term assets increased by $52 million, primarily from a $42 million increase in property and equipment, and a $5 million increase in operating lease assets. All of that made for Volta's total assets to decline by nearly $35 million. Seeing those cash and current assets lines shows us why Volta will be needing to raise capital soon. If they aren't able to complete this capital raise, Volta's future is looking pretty bleak, to be honest. Having a look at the liability side, we're seeing increases to their accounts payable, accrued expenses, and deferred revenue. Warrant liabilities declined though, leading to their current liabilities increasing by only $9.6 million, and long-term liabilities increased by $2.3 million. Volta also provided information regarding the search for a new CEO, saying that the search is still in progress. Vince Cubbage said during the earnings call that there are a number of people that would like the position, but the best of them want to see some of Volta's issues resolved before joining. The main issues being the capital raise and Volta's cost structure. The current team that's in place is in direct result with the need for change around those issues, and the board wants to make sure they have a company that matches the caliber of the person they want to have serve as CEO. He said that the board is very involved and does not want to hand the company to someone that has a different perspective of how to execute the opportunity that's so obviously right ahead. That's taken from Vince Cubbage during the earnings call. Moving along, we can see a breakdown of the revenues on the income statement, almost all coming from the service category, which includes revenues of $11.2 million from media and $3.6 million from network development. Both of those are included in that service category. No revenue is reported under the product category, which has included the sale of stations to site hosts, something that made up a much more significant portion of Volta's revenue in the past, but has now been cut down to zero. Volta said they don't expect any material increases for that category going forward, as they're slowly phasing that product offering out. Year over year, the other revenue category is up substantially, $553,000 coming from the low carbon fuel standard credits and Volta's Predict EV software as a service offering. We can see that gross margin came in at 36% for quarter 2, and since service costs are relatively consistent while service revenue is seasonal, gross margin is also seasonal. Quarter 1 gross margin is often very low. It was even negative in quarter 1 this year, but quarter 3 gross margin should be around 40% and quarter 4 somewhere closer to 60%. Looking further down the income statement, we can see that selling, general, and administrative line, by far the largest standalone number on the statement. I thought it was really great to hear Stephen Polatsky acknowledge that during the earnings call. Volta had total operating expenses of $59.7 million. Subtract that from the $15.3 million of revenue, it comes out to be a $44.4 million operating loss. Interest expense moved that number up slightly, but the decline in stock warrant liabilities brought their net loss down to $37.4 million. Seeing those expenses coupled with their current assets from the balance sheet demonstrates the need for Volta to raise money. If they kept growing their business at their current rate, they'll run out of money probably at some point next year. So a capital raise is pretty much a necessity for Volta. So that wraps it up for the income statement. Personally, I'm becoming a fan of Volta. I think they obviously need to raise money and fix some of those issues with their expenses, the SG&A line being the main culprit there. I think they've got a good business model. It's great for retail areas, probably not so much for other settings like multifamily residential buildings and office buildings. Those other non-retail areas are where other companies can benefit. But I think for retail locations, Volta's got the right model. They aren't dependent on getting high margins from the sale of electricity like some others are, and the product is better for drivers, site hosts, and Volta itself. But all of that won't matter if they can't raise money and fix their problems. I personally don't own any Volta stock at this time. The price needs to come down for it to make sense for me given the risk with the company at this time. If the valuation comes down and they're able to fix their biggest issues, then the stock is a lot more appealing to me. If you want to hear more about Volta, you can check out my previous video. That's a general overview of the company. And if you want to hear about other EV charging companies, I've got a video on ChargePoint you can check out. I'll link both of those videos down in the description. I'm planning on doing more videos on Volta and many other companies as well, so subscribe to the channel so you don't miss out on anything. That does it for today's video. Thanks for watching Stock Probe, and I'll see you in the next video.